Welcome to Real Vision's Trade Ideas. Today is the 19th of April, and I'm about to sit down with Joseph Trevisani, Chief Market Strategist at Worldwide Markets. Let's see what he's looking at now. So Joseph, what's your trade idea?
Well, I'm looking for a way to take advantage of volatility in the markets, particularly the equity markets. We saw a huge spike in volatility in February and March. Volatility is the lifeblood of trading. If the markets don't move, if there's no volatility, people don't put on trades, you don't get a lot of action. We've seen that big spike and now it's calmed back down. So I'm looking for the place or the indicator where you're going to get returning volatility. And I think in the equities, the risk for volatility and for large movement lies on the downside, not the upside. The reason for that is quite obvious. Everybody's long. Even after the pullback we've seen in the past 2 months, markets, especially equities, are very long. I mean, if you look at the S&P, from the middle of 2016 until right now, it's still up about 35%. That's a huge amount of profits that are waiting to be taken. And profits almost always do get taken in the markets. So that's what the trade idea is. Two different ways of expressing it, one in the volatility index, one in the S&P itself, but that's the basic idea behind it.
So why don't we talk about the S&P or the SPY ETF?
Right.
How do you use that for this trade?
Well, that's the ETF. The SPY is just an emulation of the S&P index, S&P 500. As I said, the risk for equities is on the downside for volatility because that's where the positioning lies. Everyone's long the equities. If you look at the charts from the past year and a half, it's an astonishing run up. Primarily, it's based on anticipation of better U.S. economic performance, some of which we've gotten, some of which we haven't. Well, what's in the future, we're not sure. So if you get a move down to certain levels, the level I chose is 258, then the internal positioning of the market will provide the volatility, will provide the movement. Because once it starts to go down, especially below or near lows that it's had the post-January high, everyone starts to worry, want to get out of their positions. Why? Because they want to lock in their profits. So if you get a movement like that, the internal dynamics of the market will provide you the volatility as everyone scrambles to get out of their long positions, and that will drive movement.
Why is it that people haven't been scared off yet due to the volatility? Is it because we had such insane growth that people haven't been completely scared out of being long?
Well, I think the economics haven't been determined yet. If you look at 2017 in GDP, which is the primary statistic I'm looking at, you had the second and third quarters were 3 and 3.3%. The fourth quarter was 2.5%. Those are all pretty good numbers. I think the market in general is looking at 3% because there was a great deal of commentary that, well, we haven't had a year of 3% growth in a decade or something like that. So I think that's kind of the focus. If you get that, especially now into 2018, where the administration's economic policies, primarily the tax cuts and the regulatory changes, where they're now expected to make that difference in the economy. If it's true, as many people said for the past 8 years, that the U.S. economy, being a mature industrial economy, has kind of an upside growth limit, that 3% is probably the top. That was one point of view. The other is no, some of the policies of the prior administration were not conducive to extra growth. Without making a judgment on that, we're about to find out whether or not that's true. So I think that's what is the determination and where we're going to go forward. Right now in the first quarter, the Atlanta Fed GDP Now program, they call nowcasting, meaning it's just a much more quickly updated economic model, that's all it is saying 2% growth in the first quarter. So we're going to have to actually wait till the second quarter, most likely, to get a real determination on this. That's a lot of room for volatility. If sort of the intermediary statistics over the next couple of months don't show accelerating strong growth, then you will get the equity indexes descending, and there you have potential for volatility. Because of that dynamic, the long people in the market, which is basically everybody, will need to cut some of their positions to retain their profit.
When we look at economic indicators, though, is there a disconnect between when we think the economy is doing well and actual figures like wages being fairly stagnant?
Good question. Interesting question. And I think there is. Part of the reason has to do with the history and the layover, if you will, from what happened during the financial crisis 10 years ago. The drop in employment was so precipitous and so sharp that many people, I think, did not come back as they normally would to the markets. And this has depressed wages despite the low unemployment rate. I mean, we all know that the unemployment rate that we quote, the 4.1%, what it is now, is a construct. It doesn't include a number of categories of people who would like to work or in other circumstances would be working. It also doesn't really include people who have not looked for work they have to have looked for work in the past month in order to be included in the unemployment statistic. So I think you're right that the wages is and has been a drag on economic performance. Because after all, we have an economy which is largely consumer driven. If people are not being paid more, then they are not spending more because they don't have the money. So the indicator on that one, I think, is the underemployment rate, the U6 rate, and the labor participation rate, both of which have started to move back, meaning people who've been out of the market for a long time are coming back to the market. But I think you're right that this would be one of the indicators that the market would look at if, along with GDP, to predict better economic growth in the future. If you get wages performing better and economic growth performing better, then I think you have all the pieces for 3 or 3.5% growth, which we haven't seen in some time.
So for now, how are you putting this trade on using the SPY?
I think that the volatility risk is on the downside. So I would be short at 258 as an entry stop, expecting that if you get to that level, which is just about below all the volatility and back and forth that we've seen since the beginning of February, if you get to that level, then all of the people who are still long, and that's pretty much everybody, are going to start thinking very seriously about whether they need to cut some of their positions to take profits on that long run up for the past year and a half, and actually the long run up from 10 years ago, from 2008. So I think that's the way you would enter into this trade. If you get to that level, then suddenly the market is not actually looking outside of itself for indicators. It's going to be looking internally. We need to take some profits, and that will drive it.
And where do you exit the trade?
I would exit at about 245 below. I still think that the equities are headed higher over the next 3 or 4 years, but when you get that kind of run up, that 35% run up in a year, that is not purely, shall we say, an economic event. It's a market event. And market events mean they're trader events, and that means that people need to take profits. So that's where I think it would go. You almost always get that kind of retracement after a move like that, especially a rapid move like that. And then I think it goes back higher because I think long-term the economic process in the U.S. are pretty good.
So then what is the time horizon for this specific trade?
Well, I tend to like long trade horizons, as you know. But for this one, I would say it's relatively short. I would say 2 to 3 months after getting into the position, because the volatility being internally generated will spend itself. The people who are going to remain long will remain long. The ones in the middle who want to take their profits will do so. And so that will, it's much like a stop loss run, a particular stop loss run at a level, which is essentially what it is, but for the whole market. Once the impetus, the people who have placed their orders at a particular level, once those orders are executed, the fire goes out of that move and the general trend reasserts itself. And I think that's what we'd see here.
All right. And then any risk that you see, anything that might make you change your mind?
Yes. The risk could be that if there is a topical or a news event that drives the market to that particular level, but it doesn't really predict it doesn't engage, shall we say, the internals of the market for taking profit levels, then of course you need to stop on the upside to get out, and I would put that at 261. As far as the general run goes, if generally economic statistics don't provide you with a reason to go higher, then sooner or later here, they're going to provide you with a reason to go short because everybody's long.
And there are a lot of news events these days, so
there are a lot of news events.
That does make the risk rather high of that.
It does. I mean, the interesting thing we've seen in the past couple of months, certainly, is that a lot of the political and, I won't say socioeconomic, but the political risk, both domestic, or the political events, both domestic and internationally, haven't really affected the markets a great deal. I mean, there was a flurry when the North Koreans sent a few missiles in this direction, in that direction. There are a few other flurries about things, but none of them have really, I think, put fear back into the market, the kind of fear that would drive investors out of whatever they're in, risk-based, because they're looking to make return, and into safe havens in whatever market it is, whenever you would do that. We haven't seen that. As far as the domestic brouhaha, shall we say, I don't know where that word comes from, they haven't really had any effect at all. I don't think the markets are really looking at the political machinations in DC as very important. They're looking more at the underlying interplay between the actual economic policies and tax policy administration and the economy, and whether there's potential, and whether the scenario that the US now has a 3% cap is true or not. We don't know, but I think markets are looking to find out.
And what's the 30-second pitch for this idea?
Anyone who missed the volatility of February and March, fear not, it will come back, and I'm trying to take advantage of that. The risk, as I said, is on the downside in equities. That's what you're looking to capture in either the VIX or in the underlying index, which is the S&P.
All right, Joseph, thank you for joining us today.
My pleasure.
So Joseph likes shorting the S&P 500. He says there is risk to the downside if equity bulls reduce their positions. Specifically, he suggests shorting the S&P 500 ETF, ticker symbol SPY at 258. His target price is 245 with a stop loss at 261. And the time horizon for this trade is 3 months. Just remember that this was a trade idea and not investment advice. You should do your own due diligence, assess your personal risk tolerance, and invest accordingly. For Real Vision Trader, I'm Alyona Minkovski.